I'm fortunate. I guess it's for maybe Jenny's misfortune today. Jenny Harrington, who's with us, along with Bryn and Joe, you own these shares of NYCB. And you had sort of pledged to stay with them for the time being. The last time we spoke, when there was a flare-up.
So we've been working out of it. So we've been working out of it. So the position, thankfully, is down to a very, very small amount, for better and worse. You know, some natural, some selling, but we've been using limits and getting out slowly. So that stinks. But I think, I think the best thing you do is try and learn from a mistake. And before any of Steve's commentary, I thought it was interesting because I wrote down, do not extrapolate this to all regional banks. And since I've been so acutely, painfully involved in this from the beginning, I don't think we should extrapolate it. Like, this is a management and messaging disaster. Harvard Business School should do a case study on how to message and deal with something as poorly as possible, and that's what they've done. And to your point that you just made about maybe the regulators shouldn't have let them acquire Signature, no, in retrospect, they shouldn't have. Because what that did was bump them into that $100 billion asset level, and what this arrogant management team did was fail to realize a year ago when they got those assets that they should have brought in other management who had experience at the big bank level. They should have brought those people in a year ago. If they'd brought them in a year ago, maybe they would have managed that transition to a larger scale bank better. Maybe so there's just kind of everything going wrong. The other thing that I want to make a point on is this share price at $1.86 is really upsetting. And part of it is because there's a lot of predatory players out there. Companies that deal in distressed real estate, companies the investment bankers who are out there. And there's too many parties right now incentivized to pick off NYCB's there's a lot of really valuable assets there. Real estate, loans, mortgage servicing business, and there's all these predators who know how to manipulate the share price very effectively so that they may be buying those at fire sale assets. We, the public shareholders, get punished the most. It's a huge disappointment. I think you just work your way out. This is also a reason when, I often say I'm trimming a position when it gets oversized. This is why we trim positions. Yeah. This was a great stock 2 months ago. This was an amazing stock a year ago when everything else was going down. And you just trim when things get overweight because you don't know when you might get bitten. Yeah, I can hear the disappointment in your voice. I can see it on your face. Never fun to be in this situation. I appreciate you sharing your thoughts. So, Joe, the idea of not extrapolating too much from NYCB on the other regional banks. Now, I could say, okay, that sounds good, and we're not suggesting that NYCB's issues are any other regional bank's issue. However, one of the reasons why there hasn't been broad support for small caps and the Russell 2000 in general when talking about a more broadening stock market is because of fear of other issues coming up with other regional banks. So one bank's problems is not another. However, one bank's problems underscore a broader issue that has investors still nervous.
I think the broader issue is that we're going to have this continued consolidation in the regional banking industry. And I think that's what it is. And if you look at the trading activity today, the Russell appears to be okay. The NASDAQ, the S&P, they're towards their highs. Apple's actually green as we're talking now. So I don't think this is a larger problem. I do think this is evidence that the big banks get bigger. I do think this is the evidence that the JP Morgans are going to continue to benefit from the consolidation that we're witnessing. And look, this is awful. This is a horrible set of circumstances. There are people that have NYCB in their retirement accounts. You feel awful for them. And there's a lot of blame to go around right now. The FDIC, should they ever have allowed this bank to buy the assets of Signature Bank? Obviously, clearly, they should not have. So there's a ton of blame. I blame the management of New York Community Bank, the way they've handled this, even the fact of allowing the potential need to raise capital through an equity sale to get out and break in the media. And Jenny, it's the free market. This is what's going to happen in the free market. The free market is going to find that predatory behavior. But I think this is a classic example of we are going through in this country a much needed consolidation in the regional banks.
So to your point on, Mike Mayo of Wells Fargo Securities has been making the point Goliath wins as a result of these types of stories, and sort of what Joe was directly suggesting too, that the biggest financial institutions in this country are the ones who either get bigger because they take up some of these troubled assets, and they're the ones who come out in the forefront. I don't want any of this to overshadow, Bryn, the point that Steve Leisman made for us of Chair Powell's testimony today. maybe a hint of dovishness mixed in there. Yes, stayed the course on, well, we're probably done hiking, and it's going to be appropriate at some point this year, likely to start cutting rates, but we're in no hurry to do so. The market seems to be just fine with everything that happened today because he didn't say anything we didn't already know.
Right, and the 10 years almost back at 4%. Right, so you're seeing rates come down on the long end, a little bit more dovish. I do think it's ironic that Powell's testifying about the banking system on the day that this is happening once again, a year later with New York Community Bank. And so I just think that everyone is like in this amped up environment where every inflation read, every ISM read, every read, people are like, inflation's going to go back to the 70s again. I think we can just see the inflation numbers are coming down. I think there's definitely precedent to get 1, 2+ rate cuts for the year. I think ultimately that will help stabilize the market, and we'll hopefully see earnings grow, because that's really what you want to see. And ultimately what I want to see is I want to see the Fed out of the market. I want to see them stop manipulating the market and just be like passive and not be this like invisible hand that they've been like for so many years.
Well, I mean, I think the genie's out of the bottle on that, or the ship has sailed, or whatever you want to say about that, because I think we've learned our lesson since 08 and 09 about the role that the Fed is capable of playing, and maybe even more importantly, willing to play at times of need. Silicon Valley Bank was a perfect example of that. One of the reasons why it perhaps didn't become a bigger earthquake than the tremor that it was at the time was because the Fed came in when it did and stabilized that institution, and perhaps in the same light, the banking system overall, at least from a narrative standpoint. Jenny, so again, we're not learning anything really new from the Fed chair today, but I think the big takeaway is they're close. They're close to getting confident, the word he used, enough to start cutting rates.
Right, and I can't wait for that to happen.
It's not if, but when.
I can't wait. Because when you have a dividend income portfolio, which has an all-cap mix, right? So there's a lot of small cap in there, there's some mid-cap, there's value-oriented, there's companies with leverage. Boy, those are the ones that would benefit the most when rates start to come down. And even though their businesses are actually fine, and interest rates haven't been so high for so long that it's really had a negative impact on their interest payments, which it hasn't, psychologically, it's really been the like wind in the face of the kind of stocks that I invest in. So I'm very looking forward to a cut in rates. That's it. Sorry.
Yeah, it's funny. I mean, we don't have a camera that is able to get you the shot, but at the post adjacent to us is where New York Community Bank Corp trades. I can't say that there's a large crowd of specialists or market makers on the floor here who are gathered around, but you've had a few sort of come by every now and then as the stock is halted for news pending. When it reopens down right now 42+%, I'm sure we'll bring you right in the moment of what this actual new news is, but we told you about this hopeful capital raise on the bank's part to shore up its balance sheet.